Have you looked at your insurance policy lately? It's crazy. You're probably going to be shocked, just like I was. Let's talk. Hey everybody, it's Tim here at Midwest Mentors. The other day, boy was I surprised. I got my homeowners renewal notice in the mail. I looked through it and oh my, I hadn't been paying attention. I had a bunch of surprises. It wasn't good. Now, I knew the price for insurance was going up. What I didn't know was how some other areas have changed that are highly significant. Let me first say that I'm not an insurance agent and I'm not trying to sell you anything. I encourage you to do your own research. I merely hope to point out some things I haven't reviewed in a long time that shocked me when I did. To me, these were the biggest shockers. Check out the limit of liability section, as this was very important. Now, this is on your declaration page. It's my understanding that this is the upper limit the insurance company would pay in the event of a loss. Now, for me, my house wouldn't sell for that number that's listed in this section. It makes sense to me to have this number cover what I think it would take to rebuild my house in the event of a claim. However, my insurance company uses this number to base my deductible on. Now, let's make sure we're on the same page about the definition of a deductible. The deductible is the amount I would have to pay in the event of any loss. According to my policy, I would have to pay 0.5% of the insured value for any claims. That math works out to be $4,233. For hail damage, my policy has a 1% of the insured value as a deductible. This works out to be $8,467. That's a lot of money. The big shocker for me, however, was the deductible for earthquake. On my current policy, I would have to pay the first $169,340 of any claim related to earthquake. That's crazy. What that means is if it costs $170,000 to rebuild my house after an earthquake, I'd have to pay the first $169,000. Another thing to point out, check out the amount under your loss of use section and ask yourself this question. Would this amount pay for a place for you and your family to live in the event of a total loss? Maybe a year, maybe 18 months. Could that amount cover it? If you're like me, this could keep you up at night. So here's what I've done. Number one, I talked to other companies. Now, what I found is that when I compared the total annual price of my auto and my homeowners policies, that my current company was in line on price, so there was no savings there. Number two, I evaluated the insured amount for my dwelling to make sure it was in line. Since this drives the deductible, if this number is overstated, all the deductibles would be higher as well. So I ended up lowering the amount of my insured value. Now, sometimes that sounds like a bad thing, but in this case, I paid less premium and my deductibles, if there were a claim, are going to be less because of the lowered insured value. Then finally, number three, I looked at the price to get my earthquake deductible to 10% instead of 20% of the insured value. Now, this did raise the annual premium by a few $100s, but I felt it wise for me so that I could avoid such a huge deductible in the event of an earthquake. Now, a 10% deductible is still a huge number, but that's the lowest my current company would go. This is a complicated topic as there are many things to consider. My recommendation is that you first analyze your policy to familiarize yourself with the details. Next, I would recommend discussing your policy with someone you trust who doesn't have a vested interest in what they recommend. Lastly, I recommend talking to your current agent and other agents so that you truly know the particulars of your policy and what your options include. Hey everybody, thanks for watching. Here at Midwest Mentors, we really want to share the mistakes that we've made so you don't have to make them too. Can you help us out? Can you subscribe to this and like and tell a friend? It would really help us out. Thank you, everybody. God bless.